we were very bullish on energy. And then again in 2024, when gold broke out, we were all over that, and also the other hard assets and the gold miners in 24 and 25, which I don't think I have to tell you guys, it's been just unbelievably lucrative for those that have been on that theme, despite Friday's bloodbath, and of course, nice bounce back today. But it's been one of the most incredible rocket rides I've ever seen. So I guess I'm giving you this because I want you to realize that when we're in sync, it's probably not a bad idea to consider our opinions. We may be wrong and you may reject it, but we both concur today that there is another major shift going on. And just like with gold in 2020 and energy in 2021, and gold again and silver and the metals in 24, 25, most people have very little exposure to this area. So this is, I think, a very critical presentation. I'm quite adamant that this is not just our opinion. We're seeing very hard evidence, as we're going to see here coming up, of the market confirming our views. So that's one of the things that I always look for is, we can have a great theory, but if the market's telling us we're wrong, maybe we need to re-examine our thinking. So really what we're talking about here is what some people call the great rotation. I'm saying, just to be a little different, the great reversal. Is it upon us? And I think this is a situation where we're not forecasting, we're observing. And this is a quote from another friend of mine. And I think this really gets right to the heart of what we're going to contend. I've just got to move things a little bit here. I'm often asked, this is James Aitken. If you don't know James, he is brilliant. Scott Bessent was one of his clients before he became Secretary of the Treasury. He got other very significant clients I probably shouldn't mention, but this is what James recently said. I'm often asked, how is Europe going to fund the purchase of the ever-increasing amount of boons and joint EU bonds they're going to issue? The answer is staring us in the face. They will fund it out of the S&P 500. So what he's really saying, and what I certainly agree with, when I want to hear Louis more on this, is that there's going to be a shift of capital, and I think it's going to be in the trillions out of the United States into other markets. Now, this is not meant to be a scary bearish thing. It's actually meant to be a call to action. It's an opportunity. So let me go to the other thing that has been very similar to this, and this is actually the giant mindless robot theme, which comes from Mike Green, who's another friend of Louis. And I do think that while that has been an extremely powerful force, and I should explain that if you don't know what it means, it's basically this persistent and very large fund flow into the market from basically 401ks, other retirement plans. And a key part of this is that it goes into index vehicles. And I actually came across a quote just today at lunch, reading research as I always do, from Charles Gove, Louis' dad, who says indexation is nothing but momentum buying. And that's so true. So all as these hundreds of billions of dollars come in each year from the giant mindless robot, they automatically go in index, which buys more of what's already big, and the big get bigger. It just feeds on itself until something turns. And that's the point that we're going to make. We're going to provide what we think is going to be the catalyst for this change. So this is about where I want to.
Can I interrupt you, Dave? Sorry,
Mhm.
because Charles actually likes to say that indexation is socialism.
Right.
Um, it's socialism on two fronts. And I'm sorry to interrupt, but I think this is a super important
That's
point.
okay. No, it is. It's a very
So
important point. We'll go back here.
it's a super important point. It's indexation is socialism on 2 points. Because first, the idea is everybody should get the same returns on capital. So the idea of socialism was everybody should get the same return on labor. Like, everybody shows up to work and everybody gets paid the same. Here, everybody shows up to invest and everybody gets paid the same. So, which is sort of, paying everybody the same for work didn't never worked. It's then people don't work, and everybody getting the same return on capital also is first way it is. But the second indexation is socialism is in socialist country, whether the Soviet Union, China, etc. The only guys who had access to capital were the biggest guys. So you are the biggest steel mill, the banks would lend to you. If you were a startup, there was no such thing as a startup. You wouldn't get access to capital. And indexation is just that. It just provides more and more capital to the biggest guys who don't always need it. It's you bid up Microsoft, you bid up Apple. These guys don't need capital. They really don't.
Well, they
The
didn't. The
the
AI thing is kind of changing that for some of them, but that's okay.
Yeah.
That's a bit of a
No, no, that's
segue.
another discussion. You're right. Well, but actually, maybe that's how the system mends itself, is the system keeps throwing capital at these guys, and now they're just pissing it away. Which is what ends up which is incidentally what ends up happening in socialism. All the money goes to a handful of big state-owned companies who just totally destroy capital. This time, the companies aren't state-owned, but they're owned by Vanguard and BlackRock index funds, etc. So they're not owned really by anybody. Nobody looks at what the management is doing, and so the managements end up paying themselves big money and pissing the money away, which is exactly what's happening. So it is socialism, and you'll end up with the same result, which is destruction of capital. Sorry, I
Very well
interrupted.
said. And I want to bring up a tangential point, but one that is relevant. And because I know there's people that are thinking, well, how much is this giant mindless robot really pump into the market each year? It's, 300 to 400 billion. And if you look at the size of the S&P, what, 40 trillion, something like that, you might say, well, that's just a drop in the
70, Dave.
bucket. But I
70.
think this is a very important point, Louis, that Mike has made, is that because of this indexing phenomenon, there's so little float. So that so many of those shares are locked up inside these index funds, which only buy, I mean, on a net basis, they only buy with these flows coming in. So that the amount of shares available for this new money coming in is actually quite limited. So his contention is it's like $6 or $7 trillion of market impact. I mean, I'm sure you've heard him say that. Do you have any thoughts in that regard?
No, I look, I think Mike is absolutely right. We all know markets are made at the margin. What matters isn't as much the market cap as the marginal buyer and the marginal seller. If there's one share is too many, the prices tank. If there's one share is too few, the prices go up. And if you have, mindless buying of shares, once again, you end up with prices that don't really reflect a reality. So no, I think indexing has been a massive factor. Look, it's been part of the U.S. exceptionalism trade. It's on the one hand, the U.S. has been the one market where most of the money has been indexed relative to any other market. I think saying more than two-thirds of the buy orders and sell orders every day now are from index funds. So indexing has been a huge factor in the U.S. market, and at the same time, the U.S. has outperformed. Is it a coincidence, or is it cause and one leading to the other? Um, Now you could say I have a lot of sympathy for Mike Green. He's done more work on indexing than probably anybody out there, including most academics. And he's been very early on highlighting all this, etc. Now, once you read all of his papers, you're like, you come to one or two conclusions. It's, well, if you can't beat them, join them. If this is the trend, might as well write it silly. And this is how we make money in these markets. So let's not fight it. Let's embrace this trend. Or you could say, alternatively, okay, fine, but this is going to lead us to an epic disaster.
Yeah, and I think that's what he believes in his heart of hearts. He said that a number of times. But interestingly, I don't think you know this. I listened to a podcast recently with Adam Taggart and Carson Block, who you know well, famed short seller, and he's even afraid to sell short right now. And he was basically saying you can't fight the giant mindless robot until we start to, for example, get a spike in unemployment. Because if there's a spike in unemployment, then those inflows from retirement plans might actually go to outflows. And that's what almost everybody's watching. And that's legitimate. And we're obviously seeing look at all the layoffs announced here just recently with Amazon and UPS, et cetera. So that's good to look at that. But what they're not looking at, and to this point, you were just at a very prestigious investment conference whose name I can't mention, but you said there's like virtually nobody talking about this potential for a major capital shift away from the US. That's where I
So,
think the market could have a real blind spot.
no, no, absolutely. Well, look, to your first point, um, I do think policymakers are aware now that if the stock market ever goes down 5 or 10%, it opens up uh, bigger problems down the road, and that's why each time you've seen a policy shift from the Trump administration or before that from Biden, and the stock market started to stall. Immediately, either the policy was reversed, think of the tariffs post-Liberation Day, um, or money was just thrown at the problem. Um, Now, the end result is the one you highlight, which is that okay, that's fine. If we have U.S. policymakers that now explicitly say, you know what, the S&P is part of my KPI. I can't let the S&P 500 go down 5% because that might open floodgates, etc. The end result. is the currency obviously becomes the variable of adjustment. And
Ah,
I think we've reached that point. And
okay,
to your
well,
point
let's
on
hold
this,
just hold that thought for a second, because that's a great lead in, such a great lead in for this slide. I couldn't
yeah,
resist.
yeah, yeah. No,
So
look,
here's the Bloomberg dollar. And I want to explain to people that don't, you know the difference here, but most people look at the Dixie, the DXY, which we'll look at in a moment. But this is a more diversified index. The Dixie is very heavily weighted between the euro and the yen. It can be misleading. But the
yeah.
point is, when we look at both of these, we're seeing the same breakdown message. So a lot of the people that are listening to this today, Louis, are really kind of indoctrinated with my breakout, down multi-year thesis. And so what we clearly have here is a multi-year matter so much to this main theme that we're talking about today is because international investors, if you look at last year, the S&P was up, what, 17, 18%, but the dollar was down about 9%. So they had very, uninspiring returns
Well,
last year,
now actually,
dollars.
if you look at the past 12 months, investors from Europe, investors from Korea, if they haven't hedged the currency, they're actually down on the S&P. If they just bought the S&P 500, they're like roughly flat. So whatever you made on the S&P, you've lost on the currency. And I think this is an important shift that's going on right now that most people aren't aware of, is that last year U.S. actually underperformed pretty much every major market out there. Not all of them, but most of them.
Most
And
of
then
them.
and then adjusted for current currency, it definitely underperformed. And starting 25, starting 26, sorry, 2026, it's exactly the same thing again. So no, look, the dollar. If you're going to say we're not going to let the S&P 500 go down, that's fine. Um, but then the dollar becomes the variable of adjustment because on the flip side, what you have in the US is you still have a country that essentially has been running and will continue to run twin deficits of over 12% of GDP. You have budget deficits of six and a half, 7% of GDP, and then you have current account deficits of anywhere from 4 to 6% of GDP. Um, Concretely, that means that unless foreigners are willing to buy more and more US assets every year, the US dollar goes down. And foreigners have been willing to buy more and more US assets over the previous 10 years because they were essentially the only ones going up. But that's no longer the case. Yeah, other markets are doing fine, for a host of reasons. The dollar is now going down. So if you're a foreigner, you no longer feel as compelled to invest in the US as you did just a few years ago. So that part of the landscape is shifting. And again, the first variable of adjustment becomes the dollar.
Yeah, that's why I think it's so important when we look at these charts. We got the Dixie coming up, but I also that you reminded me of something you've told me, offline or multiple times in the past that you've been to a number of client meetings. And for people who don't know that or really aren't familiar with Louis' job description, what he does on a daily basis, I think he
As
racks
little
up
as
more
possible.
frequent. Pardon me?
I do as little as possible.
Well, one thing you do is meet with a lot of clients all over the world. And
I
that's
do.
really where I was going with this is that I believe you're hearing from a number of your clients who often are money managers that they're hearing from their underlying clients, why are you so exposed to the US? Am I right about that?
Yeah, no, it is. Look, um, being overweight the US was the winning trade from essentially the post GFC, the post 2008 mortgage crisis onwards till about a year and a half ago. That was, oops, sorry, I forgot to turn off my phone. That was for sure the winning trade. Um, and it corresponded to a lot of things. If you go back to the post 2008, 2009 environment, what was funny was everybody was running around saying, "Oh, it's going to be a lost decade. We're going to get low single digit returns forever. It's going to be um, uh, a new normal." You remember all this, right?
Oh
And
yeah, no, I remember how people were gaga over the emerging markets. That
yeah, yeah, no,
money
and
management firm, I won't mention their name, but they ran those ads on CNBC for about 2 years. Must have cost them millions that you should buy emerging markets because of their structurally higher growth rate, which
yeah,
was
and so
true from a GDP growth standpoint, but was dead wrong from a stock market performance.
exactly. Because meanwhile, what did you have in the US? You had a situation where the US was starting to have the lowest cost of energy in the world, thanks to the shale revolution that was really starting to kick in. The US dollar was super cheap. US back then was, if you were a foreigner and you'd come in, you're like, oh, this place is super cheap. U.S. labor was amongst the most productive in the world. So you had cheap energy, cheap labor, cheap currency, and you obviously had the cheapest cost of capital. And this mattered because essentially, because growth was so weak, the Fed and the Treasury essentially had no constraints. So the Fed could do QE1, QE2, QE3, throw money into the economy, money that in the past might have gone into real estate, that in the past might have gone into fueling economic growth. Instead, it was going into equity prices, and equity prices kept going up. And already back then, people were talking, oh, but this is a profitless recovery. Oh, this is a jobless recovery. Oh, this is a K-shaped. Only people who own stocks. This is why Trump got elected in 2016. We forget this because stocks did great, but 2009 to 2016, growth was actually very subpar in the
Right.
US.
True.
We forget it, but because stocks were doing tremendous. Now, fast forward to today, and the situation today is completely reversed. The US no longer has the cheapest cost of energy in the world. It's not even close. Today, China has the cheapest cost of electricity by multiples by its so you've got that. China definitely has the cheapest cost of labor. My favorite point is that if you compare the Shanghai Tesla factory to the Fremont Tesla factory, the worker in Shanghai costs less than the health insurance of the worker in
That's pretty
Fremont,
amazing.
and he produces twice as many cars per worker. Like they produce per worker, they produce twice as many cars in China as they do in Fremont. So you got a much cheaper cost of labor. Currency wise, the US is now so expensive. I'm sure a lot of people on this call are either abroad or Americans who travel abroad, and they'll know that the US dollar is now very expensive. And so the situation, 15 years ago, everybody was telling you the US is going to be a lost decade, and the US ended up giving its 15 best years and today everybody tells you US is exceptional, the rest of the world is uninvestable, etc. Meanwhile, the underlying conditions have actually gone 180 degrees.
Well, you're raising some points that are going to come up here. So, we're not going to get to all our slides. That's okay. Because in just what 15, 20 minutes, you've gotten an awful lot of insights from Louis that are valuable. But here's the Dixie. Again, this is breaking down too. So this is the more commonly quoted dollar index. Oops. Yep. Sorry. Okay, and this, well, I think this is interesting. This is from the great Michael Hartnett at B of A, that when you look at prior US bear markets, they're not like we've seen so far, down 12% from the peak. They tend to be much more significant. And of course, the big one that we were, at least the one I remember most vividly, was the Plaza Accord back in the 1980s, and that was basically a down 48% for the dollar. I don't know if it's going to go down that much, but back then we were actually in a lot better shape from a financial standpoint. Fiscal monetary, we had Paul Volcker running the Fed and instead of Jay Powell, and I think you could argue the dollar's more at risk now. This is kind of to the point what Louis was saying was if you look at the dollar relative to purchasing power parity. And this is extrapolated. My friend Jesse Felder ran this one to give Jesse a shout out. It could be down to 70 by 2032, which I know is a number of years off. But typically, and Louis, correct me if I'm wrong, but these currency moves tend to happen in long cycles, right? They don't typically last 6 months. They last 6 years or even longer. Is that fair to say, usually?
Yeah, no, look, currencies tend to be very trending. And for a number of reasons, not least of which, the investor flows we're talking about. All investors decide US is exceptional. We got to put all our money in the US. And then US starts to underperform. And so slowly money starts to bleed. And in a world in which capital flows now dwarf trade flows, the amount of money that moves around the world is primarily capital now. These trends can last a very long time. And so, no, look, I do believe we have started a US dollar bear market. When I look at an asset class, I go through four things. I go through fundamentals. Now, the reality is the US today is running by far the biggest twin deficits in the world, and it's not even close. And there's absolutely no appetite to tackle the fiscal deficits in the US. And therefore, if you want the US dollar to stay even keel, that means you need to attract more and more money from foreigners. That's just a mathematical reality. Meanwhile, you have a US administration that is very busy spitting in the eye of every foreigner. The US is not making itself like super attractive to foreigners. And this isn't
That's for sure.
a comment on US politics. It's just an objective reality. And you are seeing it. You are seeing, I won't name the fund, but one of the biggest Dutch pension fund. was telling me that the CIO of one of the biggest Dutch pension funds was telling me that they're getting letters every day now from pension plan holders, and the Dutch pension funds are amongst the biggest in Europe, uh, saying, "Look, why we still invested so much in the U.S." And he laughed. He said the U.S. is no longer ESG for us, and it was kind of a joke because in Europe ESG is still actually a big deal. But it's so for foreigners. I don't mean to sound anti-American because I'm not. I'm married to an American. My kids are American, and I very much love this country. But we also have to be cognizant, staying on the fundamentals, that you have a U.S. administration today that actually wants a weaker dollar. The
Absolutely,
Trump,
that's a great point. I mean, you're going in line with what the Trump administration wants to
yeah,
bring
no,
about.
they
You're going in
want
line with this purchasing power parity thing that's so out of whack. I
they
mean, if
want
you look at the Big Mac index on the yen is about 40% too cheap to the
yeah.
dollar.
No, absolutely. So you have a Trump administration that wants a weaker dollar. And by the way, if you want a stronger currency, that's hard to achieve. If you want a weaker currency,
That's
that's
pretty
not
easy.
that's not that hard to achieve. It's like for me, if I want to get fatter, I can get fatter. That's not a problem. It's losing the weight that's tough. So when I look at something, I look at fundamentals. The fundamentals on the dollar are pretty much all bearish at this stage. Then you move and you look at the momentum, and the momentum has clearly turned as your charts highlighted. Then you look at the investor positioning, and the investor positioning, the reality is we went through the past 5, 6 years where the single biggest investment theme amongst investors around the world was the US is exceptional, everywhere else in the world is uninvestable. US is the cleaner's dirty shirt, et cetera, et cetera. So the investor positioning, look, the US is more than two-thirds of the world MSCI. It's 22% of global GDP and two-thirds of the world MSCI. You've never seen such
No,
a
that can't
disjointed.
continue. I mean, that's a
So, so
crimson
the
red
investor
flag right there.
positioning, everybody is sunning themselves on the same side of the boat. And then finally, we look at the valuations, which is what you do here with the purchasing parity. And the valuations are still very stretched. And again, anybody who travels, the US feels very, very expensive when the rest of the world feels cheap. So today you look at the US dollar, this has to be your number one theme as an investor. We have started a US dollar bear market. From there, how do I position my portfolio? What do I do about
Okay, so
it?
let me stop you there because that's exactly what I want to reiterate. Because I don't want wealth consultants or clients to say, "Oh, well, gosh, they're really bearish because of this weak dollar." You can make a lot of money if you recognize you're in a weak dollar
Oh,
environment.
absolutely.
But here's
Tons of
another
money.
area where Louis and I were in sync a couple of years ago is on emerging market debt. And Evergreen has had a very significant exposure to emerging market debt in recent years, which has been a huge help relative to the U.S. bond benchmarks. And I think that we're still in the relatively early innings of emerging market debt outperforming. You and I were pounding the table on Brazilian bonds that were yielding 15%. Government bonds, when their inflation rate was 5, it had a 10% real yield. Are they down to 13.5 or so now? They've been falling, right? Those yields?
That's right. That's right. Look, LatAm debt had a great year last year, but we're at the beginning of a 5-year bull market on these things. The reality is, I think, you look at bond yields in Colombia and Chile, in Brazil, interest rates are going to go down 100, basis points a year, every year for the next 4 or 5 years. So, yeah, you missed the first year, but and I can go into the fundamentals. If you give me that soapbox, I'll sing. But it's like the bull market on LatAm debt has started, just like the bull market on Asian currencies has also only just started. So in LatAm, you'll make money on yields collapsing, and in Asia, you'll make money on currencies going up. So there's no, no, look, we're at the beginning of a trend, and to your point, this is an important trend, and there's many ways to express a bearish dollar view. One of them is EM debt, one of them is EM equities, another is commodity equities, another is value versus growth, another is
Okay, well,
steepening of
let's come
yield
back to
curve.
this because we got more coming up on those because that's all
Sure.
good stuff. Okay, so this is the dollar's role in reserve currency is already coming down. I'm sure
So that
you're
part,
well aware of this. I
to be
don't think most
honest,
Americans are.
yeah, to be honest on this, look, we can discuss the the role of the dollar and the reserve currency system, et cetera. But I think you can be bearish on the dollar without having to go down the wormhole of it's going to lose its reserve status
Oh,
and,
no,
and
no,
all
no. I
that
want to
stuff.
be clear. I'm not saying that at all. But what I am pointing out with this visual is that gold is becoming a much more important
It
central
is.
bank reserve asset. I think
Oh,
the
no doubt.
days of say U.S. Treasuries being the primary central bank reserve asset are over. And I don't think you would disagree with that.
Oh, no, no, I fully agree. Well, look,
There's nothing
I,
to replace the dollar as the reserve currency. I don't see
yeah,
that
but
anywhere on the
look,
horizon. Just to be
the
clear.
reality is our global financial architecture changed when we seized the Russian assets, and it wasn't just the government, but when we also seized the assets of Russian oligarchs. I think if you look at the Western world, our comparative advantage in the Western world, we have lots of comparative advantage. The U.S. especially has pocket aces, so many comparative advantages, but one of them for sure has to be the rule of law, right? It has to be that whether
Well, it
you're brown,
was.
black,
I kind of wonder
exactly,
about
no,
that
no, exactly,
now.
whether you're yellow, whether you are a Christian, Jewish, Catholic, Muslim, Hindu, you go in front of a court of law in Seattle, in New York, in London, in Paris, you can expect the same fair shake as the next guy, right? That was always the premise. And then in 22, when we seized the assets of Russian oligarchs, we added a little asterisk to this. And essentially, we said, except if you're Russian. If you're Russian, we can just seize your stuff without going through the courts, just by executive order. We're going to say, you're Russian, ergo, you're probably a friend of Putin. We don't even have to prove that you're a friend of Putin's. And so we just seize your stuff. And if you were Chinese, if you were Saudi, if you were Indonesian, if you were Qatari, you immediately said, what do you mean except if you're Russian? That wasn't the deal. Because except if you're Russian, tomorrow could be except if you're Chinese or except if you're Saudi. And so from that point on, US treasuries became a lot less, and just Western government bonds in general became a lot less attractive to anybody sitting in an emerging market. If I'm a Saudi prince and I'm thinking, tomorrow, for all I know, MBS decides to bone hack another US journalist in the consulate, and therefore my stuff's going to get confiscated, I'm going to be less inclined to own US treasuries, right? I mean, I don't know what MBS is going to do tomorrow. So that shifted everything dramatically. So our
Absolutely.
whole financial architecture, which was based on the premise that if I'm Thailand or if I'm Indonesia or if I'm China, I save money in US treasuries because if tomorrow I have a crisis of any kind, a war, a tsunami, an earthquake, I can transform my treasuries into oil, into copper, into food, into whatever I may need given the crisis. Because treasuries are liquid and there's always a market for them. That was what our financial architecture was based on, the idea that treasuries at any one time could be transformed for commodities. What we did with Russia, we said, hey, you only get access to your treasuries if we say you do, if we like you. So that completely changed the equation. And by the way, we just changed that equation again with the Maduro thing and the intervention in Venezuela, because notice, so they took out Maduro and then they seized a bunch of ships. The Americans seized Russian ships and said, you get access to oil if we say you get access to oil. If we like the buyer and the seller, then we'll let the oil flow through. But if we don't like either, then we reserve the right to intervene. So the whole system for the past 70, 80 years was built on the premise that treasuries equals commodities. And now the US has come in and said, you get access to treasuries if we say you do, and you get access to commodities if we say you do. So this, like if you're China now, that means I have no choice but to stockpile commodities like crazy. If I'm Turkey, if I'm India, if I'm a country that has any aspiration to run a foreign policy that might diverge at some point from the US, I have no choice but to say, you know what, treasuries are worthless to me. I should stockpile oil, I should stockpile gold, I should stockpile food. I need to stockpile commodities because, if tomorrow the US decides ships aren't allowed to go to China, then I'm going to have a problem.
But all what you're saying, it just further accentuates the question, why are trillions of dollars that have been coming into the market? We'll see that here recently, how strong the flows have been from overseas. And why is that going to continue? This visual here gets to your point. This is really just like a cumulative of all those twin deficits adding up and really shows this extreme vulnerability the United States has to foreign financing.
Yep.
So it just emphasizes really what you've been saying. Now, this is near and dear to your heart because you love renminbi. You've been really right about this, the Chinese currency. So this is the Chinese domestic currency. The yuan is the Chinese offshore currency, right? I think that confuses a lot of Americans.
So they're both called the yuan. Yuan is basically means buck. So the renminbi. So there's two renminbi. There's an onshore called the CNY, and then there's the CNH in Hong Kong. But they're essentially the same. So we can go down that wormhole if you want. But
I'm
it's
another confused American. But it
yeah,
is
yeah,
clearly breaking out to the upside. So that's
yes.
confirmation that there's a
Well,
major
most
change going on.
importantly, on that chart, what matters is
Notice who it's from. It's from a very good firm.
yeah, very, very, very good quality, good looking chart. It's most importantly, it's gone up 43 out of the past 47 days. which is highly, highly
Wow.
unusual because the
Wow.
PBOC usually likes to maintain the PBO, the Chinese central bank maintains a two-way market. So when they let the currency, it's not, I don't think they like fell asleep at the wheel or took a 2 month ski holiday. Um, if it's 43 days out of 47, they're signaling to their own exporters and importers, guys, because it's a little bit every day. They're signaling, guys, the renminbi is going up now. So hedge accordingly.
My
It's
dream is in a year from now, the yen chart's going to look like this.
so I think the yen moves will be more violent. The
I
yen
actually
moves,
agree with that. So this
the
is just to emphasize how reliant the United States is on net foreign savings.
yeah.
We have no basic domestic savings any longer, and that is that's very unusual. The U.S. net national savings, you can see here, is actually slightly negative. That very rarely happens. It's only happened during
But in
financial
fairness,
convulsions.
why would you? I mean, for the past few years, Americans have been, I mean, foreigners have been very happy to fund you. So it's like, well, if you're happy to fund me, why would I save? Like saving's
Well,
boring.
unless they get
Take,
unhappy, which I'm
yeah, yeah, no,
alleging.
no, that's the danger. But if you're American, like, why would I save? Like foreigners are coming in, happy days. You
One
know,
thing Americans are really good at is spending, not so good at saving.
so to your point, um, again, the variable of adjustment to all of this ends up being a lower dollar,
Yeah. And we've seen this is a major reversal.
which
Okay,
is
so
not the end of the
here's
world.
this gets to what you were saying earlier. I mean, look at these inflows. This is just since 2020. So this is international flows. And into international stocks, only 400, sorry, yeah, 400 billion, zero point 0.4 trillion, and 1.6 trillion into the US. And as you said, the US is, what, 23% of global GDP. So four times as many flows have gone into the US as to the rest of the market, the rest of the world's equity markets.
Yep.
It's pretty staggering. But
And remember, and
then,
to the point my Green was making before, a lot of that would have gone into index funds. Because you're a foreign pension fund, you think, oh, you know what, I should have more US. The US is what's doing well, etc. Just buy me the S&P 500, easy, right? And
absolutely.
if tomorrow it's a one decision, and then if tomorrow I change my mind, it's an easy one to unwind.
This should be in the commodity section, but it is an interesting one given what happened on Friday because, as I think everybody knows, it was just an epic sell-off in hard assets. And this is not just gold and silver, this is materials, flows into materials, but it was really fever pitch. And when you get that, that's when you can get these really strong reactions. But this is the same kind of thing. I mean, this is talk about fever pitch. So this is net foreign buying of U.S. equities, which it has, I think Louis would concede this, there is a tendency for international investors to be wrong way Corrigans. They tend to come in at market peaks and get out at market troughs. I mean, they have gone absolutely nuts over U.S. equities over the last 12 months. And as Louis has pointed out, over that period, U.S. equities have actually been laggards, especially adjusting for the weak dollar. So that's another, significant warning that, even international investors are offsides and way too much bought into the U.S. exceptionalism. And this is just looking, so Lou was talking about how long this is the US equity market outperforming this heavy blue line. So this has really been going on. I mean, if you look at the trough there, it was about 2007 and there was some back and forth, but I mean, it's been a long, long bull market of US equities relative to the rest of the world. Now, this is more in terms of being concerned about the market itself, but this is pretty shocking. This is, again, from Michael Hartnett. And I think this fund manager survey is one of the best for tracking. So you see the CNN fear and greed. I don't think that's very accurate. It bounces all over them. But when you see cash levels this low, I mean, this is a huge red flag. And it's really more relevant to the US market than it is to overseas market. Okay, so this is going Louis is going to love this chart. So this is looking at the iShares, the large cap, the FXI, clearly a breakout underway there. So again, the point that we're making, this isn't forecasting. This is just observing what's already happening. So this sea change is well underway. You may want to comment on that one at all?
Yeah, look, it's China had a horrible, horrible bear market. I guess your chart doesn't go back far enough, but the way you have to conceptualize China, why we had a bear market and why we have a bull market now. For China, I think it's hard to underestimate the extent to which the 2018 semiconductor embargo that the US imposed on China, how much of a shock that was to the leadership. Um, they simply didn't see it coming and they panicked. They thought if the US can embargo us on semiconductors today, tomorrow They can block us on chemical products or auto parts or any number of things. So the Chinese leadership took the decision and said, you know what? We need to de-Westernize our supply chains. We need to be able to produce everything at home because we can't trust the Western world anymore. And order was given to the banks, guys, no more loans to real estate. All the money has to go to industry. And essentially, what the government did was monopolize all of China's savings, which are massive, and shoved it all into industry. Which, 5 years later, this is why China now produces the world's best cars and the best turbines and the best trains and the best everything. But it came at a huge cost. This cost of de-Westernizing supply chain, basically putting all the money into industry, meant that real estate prices fell by a third and equity prices fell by two-thirds. Now, what it did do is it allowed China, when the US came back in 2025, Trump comes back to power, and Trump decides to not just punch China on the face, but to punch everybody in the face. Europe, Canada, Mexico, India, etc. China is the only country by that point, because it got punched in the face in 18 and spent 7 years going to the gym and getting buffed. China is the only country that can stand up to the US at this point and say, you know what, you want to go, let's go. You embargo me, I embargo you. You tariff me, I tariff you. And essentially, the U.S. realizes that without Chinese rare earths, within 3 weeks, the Ford factories are going to shut down, and so are the Raytheon factories. That within 6 weeks, the U.S. will run out of antibiotics, and so then the U.S. has to make a choice: is okay, we need to de-Sinify our supply chains, and initially that's the rhetoric coming out of the US, and then they realize, hold on, the cost of this are absolutely massive. Again, China, to de-Westernize its supply chain, had to pool all of its savings and throw the money in industry, which meant real estate prices went down a third and equities went down two-thirds. What government, what politician wants to do that in the US? You'll be lynched if I mean, the US is anyway too over financialized to be able to take that kind of pain. The financial system would implode if real estate prices went down a third and equities went down two-thirds, as we saw in
We found that
2000.
out in 2007, 2008.
It's like it's not feasible. It's not possible. Therefore, the U.S. was forced to sort of reach a compromise. Starts talking about a G2 world. You have 4 meetings coming up between Trump and Xi, and very quickly you move into a world that is far less confrontational between the U.S. and China.
That's a
So
very
that
important
allows,
point. I think people don't fully appreciate there's been kind of a détente, kind of a stealth
for
détente that's
sure,
going.
because
And
there's no
I think
choice.
that makes China more investable, far more investable than it was a couple
No
of years.
doubt, no doubt. It makes it much more investable on many fronts. The first is China can now relax and doesn't have to say, okay, all our money's got to go into industry. So China starts to shift and says, okay, we now have an anti-involution campaign. Stop throwing good money after bad in industry. That part is done. We need to get local consumer going again. We need to boost our domestic confidence. We need to boost our birth rate, which is collapsing. We need to give young people, a bit of a break. How do we boost? One of the ways is by boosting equity prices. So the government actually starts to intervene, buy stocks, put a floor on the market, and starts moving the market up. So you actually now have a Xi Jinping put on the market. So just like you had a put in the market post 2009 in the US with the Fed doing QE1, QE2, QE3, this is where you are now in China, where China is what the US was in 2009, 2010. China is now the one with the cheap cost of electricity. China is now the one with the cheap cost of labor. China is now the one with the undervalued currency. China is now the one with a government that's massively supporting equity markets and can do so because it doesn't have to worry about inflation. The problem today in the US is that if inflation picks up a little bit, given where the inflation we've had now in the past few years, it becomes a political problem. So there is actually a constraint to how easy policymakers can be in the US, and that is that if inflation heads back above 3%, you've got problems. In China, you're at 0% inflation, so none of that is an issue. So
Well, I
yeah,
want
so
to be sure to get, because I've got a visual coming up on that, but just a second here. Yeah, here we go. This is
yep,
what I wanted to show. The money
yep,
growth. So you have the money
yeah, yeah.
supply growing at a
So,
much faster clip than nominal
yeah,
GDP. And it's
and
running, it looks like
this is
about
exactly where the
12%.
US
That's
was.
pretty fast
This is
growth.
this is exactly where the US was in 2009, 2010, when the US was QE1, QE2, QE3, throwing money, and the money was just going into stocks. It's exactly what's happening in China. So today in China, what you're seeing is, big budget deficits, very easy monetary policy, lowest cost of capital in the world, and you pick up your your newspaper every day in the Wall Street Journal, the FT, and they're telling you, oh, growth in China is terrible. And meanwhile, the stock market grinds higher every day. Stock market outperformed in 24. It was the best performing market in 24. It was, second best performing market after Korea in 25. It's starting the year great. Nobody owns it. Going back to fundamentals, it's like, okay, so I've got the market with the cheapest cost of capital, the cheapest cost of labor, the cheapest cost of electricity, um, and the cheapest cost of currency. Every then you look at investor positioning. Everybody tells me it's uninvestable. Then I look at momentum. It's got the best momentum, and then I look at valuations. It's got very attractive valuations. So it's ticking all four boxes, and yet no nobody owns it. Which is, and it's by the way, it's not like we're talking about Angola here. We're talking about the second biggest stock market in the world. So
Well,
to
to
me,
reiterate what you said earlier, it's a good combination when you have modest economic growth with a tremendous amount of liquidity being injected. That's
that's
basically
right.
what the US had, as you said, come out of the global financial crisis. So this is a very good thing. And this, I think, is also really big. This is not just China. This is the world excluding the US. This is a major, major breakout. So, folks, this is all coming into alignment. I mean, and that doesn't mean there can't be corrections and South Korea, which has been a longstanding favorite of mine in our newsletter, uh, and I believe I know everybody's got an exposure there as well. But this development happened here a couple of weeks ago, where South Korea is basically going to give a huge tax break to their citizens, retail investors, to bring assets back into South Korea, so they won't have capital gains. So let's say they sell their Nvidia and they reinvest it in South Korea, they won't have to pay tax on Nvidia. Am I getting that right, Louis?
You are, but there's two parts. There's also another part where from now on, if you invest abroad or if you keep your money abroad, you're going to pay higher capital gains than if you invest at home. I think you don't pay capital gains. Essentially, it's the same thing that Poilievre had proposed in the Canadian election. Obviously, the Conservatives didn't win, but the idea is, look, you do what you want with your money, but if you're putting it abroad, you suffer a higher tax rate than if you invest at home.
And I was surprised how much South Korean investors hold in the U.S. They're a big player. I thought they were kind of a bit player, but
Oh
they're
yeah.
not. But imagine if this happens in Japan, and I think there's a decent chance that they'll do it in
What's
Japan too.
Oh, look, the Korean investors are total they're very momentum driven. Uh, they love the new thing. So they've been huge investors in the whole, US tech boom. They've been all over it. So, if all of a sudden they start selling their Google, their Microsoft, their Nvidia. Now, of course, you could say these are massive stocks, but remember, it's markets are made at the
Yep,
margin, and all of a sudden,
absolutely. Yeah, that's a huge point because I mean, if it works, what Mike Green was saying about the multiplier effect on the way up, it's going to work on the way down. I just don't think people are factoring that into their thinking right now.
I agree.
Okay, so we also got emerging markets breaking out. We've talked about that. We've been fantastically rewarded with not only emerging market equities, but bonds here in the last couple of years. Commodities, I mean, we'll just touch on this real briefly because we're at about 45 minutes, but uh, obviously what happened Friday was pretty unprecedented. But looking long term, we definitely are in the situation where if the dollar is really breaking down, commodities should do well. Now, you might want to be looking at the ones that haven't already had monster moves or buy some of those like silver when they've been absolutely crushed. There's that Dutch pension fund you were talking about that they're saying they're going to exit treasuries altogether. So this really does have the potential to feed on itself and become a real jailbreak if it gets momentum. Here's another great visual because it's coming from Gavco. This, I think your dad created this chart back in the 1970s,
78.
four quadrants. And so this upper right one doesn't say it. This is inflationary boom. This is inflationary bust. This is deflationary boom, deflationary bust, or even disinflationary, but it could be deflationary if it's bad enough. So you believe we're in here. Gold is obviously, and the other metals have been very indicative of that. Emerging market equities took a while to kick in, but they're now doing that. They're still cheap, right? They're still, what, 13
Yes.
times
So,
earnings and
no, no,
yeah.
absolutely. So look, on inflationary booms, I think when you look at this quadrant, your starting point should be that the default mode of capitalism is the deflationary boom because every CEO wakes up every morning thinking, how do I produce more with less, right? Every entrepreneur, how do I produce more with less electricity, less workers, less, you know, land? It's like you're always trying to do more with less. This is what capitalism is all about. At the same time, the natural state of democracies is an inflationary boom because every politician wakes up every morning thinking, how do I promise more to my
Right, buy
constituents
more
without having to
votes.
pay for it? And with like basically leaning on the central banks to print the money to give for me to pay people off. So the natural tendency of democratic capitalism is this sort of fight between inflationary boom and deflationary boom, and usually an independent central bank sitting in the middle is supposed to make sure that you don't need too far one way or the other. Um, Now, I would say
Well,
that
in the old
central
days, that's the way it was.
well,
I don't think
exactly.
that's the way it is going forward.
Well, central banks have completely abdicated this role in recent years. They abdicated it in Europe during the European crisis because they realized, well, if we don't intervene, the euro is going to blow up, and then our job's going to be gone. So screw it. Let's just do it. They abdicated again during COVID, and we've never really recovered since then, to be honest. So I tend to think we've been in an inflationary boom. You've got way too easy fiscal policies for where we are in the cycle, way too easy monetary policies for where we are in the cycle. China is the exception. China's been in a deflationary bust because of the trade war, because of China's attempt to de-Westernize its supply chain that pushed the country into a deflationary bust. That's why the best performing bond market, bar none, in the past 5 years has been the Chinese bond market. But what you're now seeing is China embracing policies to bring it back very much into an inflationary boom. Now,
Okay, so if you're right about this, if you're right, this is where we are, then look what's down here, technology, which is where almost everybody is way overweight. That's
yeah,
not correct. So
yeah, yeah.
this isn't an
But by the way,
academic.
technology has stopped outperforming now. Like emerging
Exactly. So again,
markets.
this gets back to that we're not predicting, we're observing.
Yep.
So this is, I think, just an incredibly critical big picture thing for people on this call to think about this webinar.
Well,
And I
that's
think you're right.
look. I think
Makes us
one
strong.
one very important point for investors to realize is that we in the Western world could follow crazy easy fiscal policies, like the US running 6.5% budget deficits with 4% GDP and not 4% unemployment rate, sorry, without worrying too much about inflation because China was this deflationary black hole in the system. China's the second biggest economy in the world. It was following massively deflationary policies. So it was this big black deflationary black hole. To the extent that China no longer is this deflationary black hole, and now is following very much more reflationary policies, then if we don't adjust our policy settings in the West, then you move into much more reflationary environment very quickly. And this is what the markets are sensing out. This is why metals are going ballistic. This is why EM debt is massively outperforming DM debt. This is why EM equities are massively outperforming DM equities. Um, and this is why commodities are starting to outperform. I think this is what oil is starting to sniff out because oil has been a dog with fleas, a three-legged dog with fleas for so long, but now all of a sudden it seems to be coming alive.
Okay,
Even if
I
it's
got
still
it
the
because I want to
dog
get to
with the
that.
butt.
That's what you just brought up is huge. Okay, so this is
Yeah.
a London Metals Exchange just showing more breakouts in commodities. This is a basket of diversified commodities, which, by the way, when the horrible decline happened the other day, it only went down about 6% because it's not that much gold and silver. I think that's an area, like I said, if you want to play this inflationary boom thing, you might want to look at some of these commodities that are more industrial based. They're economically sensitive. They're not as inflated. This is in the shares of the gold miner ETF. So that's another thing you can do is say, well, these gold miners have lagged a lot, and there's certainly no enthusiasm there. It's amazing when they were up over 100% last year that most investors were actually liquidating the senior gold miner ETF. But this is what Louis talked about. There's a major breakout happening here with XLE. We've been flagging Exxon in our newsletter, XOM, and when it was bouncing around 120, said if it breaks 120, watch out. I think it's 143 today. So we're seeing some really interesting stuff here. This is not updated to where it is today. It's up more than this. So there's some very interesting things. Suncor in Canada's got one of the most beautiful breakout charts I've seen. We know drilling activity is down. So if energy takes off, and here's just how people are weighted. I mean, the energy sector is now less than 3% of the S&P. Just phenomenal. And obviously these fund managers are not there at all.
Oh, look,
So really quite
most
an
people have more
opportunity.
change in their pocket than they have invested in energy.
Yeah. And then we had this a classic, right at the bottom for oil, Jim Cramer saying, stay away from oil at all costs. The world is putting out a huge amount of oil. There's been enormous bearishness on oil, which is one reason why, I've been, touting it, and I know Louis is a big fan of it as well. And Fortunately, we've also had natural gas, which has been a better near-term performer, but I think gold is going to play catch up. Louis, we need to get to the Q&A, but do you want to say anything before we move to the Q&A?
No, look, I've spoken a lot and I kept interrupting you. I
Well, you're
apologize.
the star of the
Uh,
show. You're supposed to
yeah,
speak a lot.
so let's definitely take questions.
I know they're out there. I know Jeff Harbaugh's got one. I can bet on that.
Yeah, I do.
Why
Good afternoon, gentlemen. Thank you for
did
doing
they
Yeah.
fire
this.
your brother in Baltimore? I don't understand that.
Look, I can't even get tickets. The story is he's probably a third cousin or something, and it doesn't help me. My father grew up in Gettysburg. They grew up in Maryland,
Huh?
so we're related somehow. But it's not any good. Okay, anyway, last week I think the French seized an oil tanker, and it was one of the shadow fleet, I think. And I'm just wondering if this was the start of a trend and we seized more and they seized more and some other people seized more, and how many do they have to seize before this starts affecting oil prices and oil supply?
Look, I think that's part of what's driving oil prices higher right now. To be honest, if I'm the old story, the old Steve Martin quote that before you criticize anyone, you have to walk a mile in their shoes. Like this, when you criticize them, you're a mile away and you have their shoes. But the if I put myself into Xi Jinping's shoes, right now I'm thinking, okay, the US told me that if they don't like me, they reserve the rights to seize my tanker. And remember, China's the biggest oil importer. India's the second biggest. By the way, I'm telling myself the same thing if I'm Modi in India. The US, reserves the right to seize my oil tankers. France is actually doing it. The US also seized a Russian oil tanker from that was going from Venezuela. So I'm looking at this, I'm thinking, okay, I've lost Venezuelan oil. They reserve the right to seize tankers, and there's massive trouble in Iran. I don't know how, Iran is one of my biggest providers of oil. I don't know how long they're going to stay alive. That regime's going to stay alive. It could get toppled. So if I'm Xi Jinping, if I'm Modi, I'm thinking, however much oil I have in reserve, I don't have enough. Like however much I have, the world has already changed a lot in the past few weeks that what I had before was for the world of yesterday, the world of today. Now I need to stock up more. So I do think we are moving to a world where now, and you could say the same thing for copper and for any number of things. Now it's much easier. Like if I think, okay, I should store more copper, I can just go out and buy it now and store it because that's not very expensive, storing copper. Storing oil is harder. You got to build up the storage facilities to store the oil. That takes, even if China's good at building inventories, that still takes some time. And same story in India. But I think the trend is there. Everybody, essentially today, two countries have meaningful strategical reserves. It's the US and China. Um, China's probably isn't big enough relative to their imports. The US doesn't really need one anymore because you're essentially more or less energy self-sufficient. Of course, different grades, etc. But by and large, you don't really need one. But we're going to move to a world where everybody's going to need a strategical reserve. Hell, if I'm Denmark, I'm probably thinking I got all my reserves in US treasuries. Does it make sense for me? Does Donald Trump say, hey, by the way, if you don't give me Greenland, I not only do I keep your US treasuries, but you don't get to have oil? Like if I'm like all of a sudden, if I'm Denmark, that's a possibility I got to think about that I wasn't thinking about 2 months ago. So the world has changed, and in a world that's now far more uncertain, where it was taken for granted by most countries that the U.S. patrolled the oceans and the U.S. had an embedded interest in keeping stability, and that the U.S. was essentially a very benevolent hegemon. Now all of a sudden it's like actually it might not be benevolent at all. It might want to take some of my territory. Like if I'm Panama, do I still think, oh, I'm happy keeping my reserves in dollars and I don't need to stock up oil? If I'm Panama, I'm thinking, well, maybe not. So now, you could say, well, they just solved their problem because they had their Supreme Court say, okay, kick Hutchinson out and get the canal back. But it's all this points to a world in which is way more uncertain, and when you're more uncertain you got to build up inventories. It's just At COVID, people were saying, oh, we're moving from just in time to just in case. I think the just in case has been amped up yet more because, again, who can predict what the US is going to do next week?
Me. Did I did I read or hear or hallucinate that some of the oil going to China out of Venezuela had been allowed to go through?
No, it did. But again, it was allowed to go through this week. If you're Xi Jinping, I don't think like, okay, fine, this week it's allowed to go through, but next week, for whatever reason, maybe it's not. Like, I don't like, De Gaulle used to say that, the first rule of a leader is you hope for the best and you plan for the worst. And now all of a sudden, the worst is a bunch of scenarios that you really weren't envisaging a few weeks ago.
Okay.
Okay, do we have another question from somebody?
We have one from Pete Turner asking how soon should prudent U.S. retail investors be repositioning to take advantage of these trends? And he notes that he almost always jumps early.
Well,
I guess that's either one of
if
you.
you've jumped early, that means you're already in because it's been going for 12 or 18 months. Um, so look, I think you look at the best thing you can do if you want to keep it very simple. You could just do a EEM, which is the ETF on emerging markets relative to the Nasdaq, and as long as you're above the 50-day moving average on the EM over NASDAQ, you keep buying EM and you just do it gradually and gradually and gradually. And then if you move below the 50 days on the relative chart, maybe you want to go back to the US a little bit. But I think that trend has already started and it's going to be with us. Or maybe you do it on a 100-day moving average. That trend has started and I think it's going to be the trend of the market for the next 5 years. So you can
And
just
there are a
average
number of
into it.
closed-end emerging market debt funds out there in local currency that you can also access as a retail U.S. investor. So for you. So we realize that so much of our focus has been on appreciation in this country over recent years, and yet the investing population has definitely gotten a lot older. I think that income is going to have a major rebound as well as emerging markets and other foreign markets. So
So
I mean, you can check with either look at our newsletter for those of you that are Haymaker participants, or for those that have their accounts at Evergreen, the wealth consultants can tell you the specific vehicles that they use.
We have
Jim's got his
two in
hand
the
up.
chat right here, but we also have Jim raising his hand. So Jim, why don't you go ahead and then I'll get to these in the comment section after.
Great. Louis and Dave, this was excellent. Thank you. I do have a question for you related to your mutual friend, Grant Williams, who released a podcast today with Michael Every. And Michael spoke about a lot of different topics, but concluded by talking about the U.S. using stable coins to back the U.S. Treasury and essentially, in my words, kind of treating them almost like a CBDC where they can then manipulate what countries are either able to buy or terms and so forth. So my question is, do you give any credence to stable coins being used to increase the purchasing or the attractiveness of treasuries? I mean, does that kind of ameliorate the
Well, just one point to make there that I think is critical, that it's short-term treasuries. There would really only be an additional buying support
foreign
bid for
capital?
short treasuries. And there's plenty of interest in those. So I think could it help support the dollar somewhat? Yes. But I think let's let Louis talk about stable coins because they were so hot a few months ago and they've really gone cold here recently.
Yeah, I was gonna say it feels a little bit like bell-bottom jeans at this point. It seems like so 2025. The whole like, oh, stable coins are gonna fund the US Treasury as crypto melts down every single day. And gold and precious. I mean, last year crypto was essentially the only asset class that went down along with JGBs, Japanese government bonds. Um, so I think the investor appetite for all things crypto is dissipating fast. And by the way, the whole like it's like, oh, I get the argument, if you're from a really crappy country, if you live in Venezuela or Kenya or anywhere
Turkey.
where you can't trust, or the Bangladesh or whatever, where you can't trust the banking system, it's like, okay, great, I can't trust the banking system, so I'm going to put my money in stable coins. I'm like, sure, fine. Uh, but is there really that much money? Is that going to really move the needle? Remember, the US is adding 2 trillion a year. So you can scoop up all the savings of Bangladesh and all the savings of Kenya, etc. Yeah, it's not going to move that needle. Of the 2 trillion additional debt. And that's, by the way, in an expansion. So I'm very, very dubious on the whole. It started a year ago. We're now a year into the whole argument. Oh, we're going to fund the treasury through debt through stable coins. Meanwhile, bonds keep selling off. The dollar keeps selling off. Cryptos themselves now keep selling off. So the flood of money that was supposed to come in didn't really come in. I don't see what that changes. What it might happen is money that's already in treasuries or in money market funds starts to move to stable coins, but then you're just, it's left pocket, right pocket stuff. If today I have money in a US money market fund and I think, oh, you know what, I can put stable coins and get the same yield, so I'd rather do that. It's just I'm moving money from the left to the right. Now, finally, you could say, 90% of US banknotes today, US $100 notes are outside of the United States. So there's a demand for dollars clearly outside of the US. And so you could replace that with stable coins, but I'm not sure that's a great deal for the US government because essentially you're replacing a banknote is a perpetual bond with a zero coupon. It's a perpetual zero coupon bond. The government prints a C note, sends it abroad, and never sees the money again. It's great. If you replace that with a stable coin, now you have to pay 4% a year or 5% a year or whatever the interest rate is. So I'm not sure it's that great a deal for the US government, actually. So bottom line, I think the whole, we've got a fiscal crisis here, but it's fine. Stable coins will fix this, to me, strikes me as complete magical thinking.
Well, there's a very decisive answer for you, Jim. Definitive, declarative.
I would expect
We have a
nothing
question
less.
we have a question from Sean, but Louis, before that, do you want to speak to the question from Jim on EEM for the good of the
Yeah,
order?
look, I'm not an EM special. I'm not sorry. I'm not an ETF. I'm an EM specialist, but I'm not an ETF specialist. The question was, which is better, EM or VWO? I think I'm not 100% sure. I think EM has slightly lower fees. To be honest, they're fine. You can so you get an average of the both. I don't feel really strongly about one against the other. I think Sean's question is actually probably more to Dave. It's probably more in Dave's wheelhouse. Well, Dave, what are the odds of the U.S. government purchasing U.S. equities during the next downturn? I mean, last time they bought corporate bonds.
Somebody's been listening to me. Yes, I think that's going to happen. But it's just like when I said that about corporate bonds, I said in the next crisis, and people kept saying, well, how come they haven't bought corporate bonds yet? Well, there hadn't been a crisis, but they did it in COVID. And actually, it was a masterstroke. It worked beautifully. And it was actually kind of along the lines, Louis' dad put out a paper here recently quoting how Walter Bagot, who, am I saying it as Bagot?
Yeah.
He used to be I think the chief publisher at The Economist, and they made that a great financial magazine. But he had this theory that when you had a financial crisis, that you needed to provide liquidity, but you should do it at a very high real interest rate. And that's basically what the Fed did in 2020 when it was buying corporate bonds at, like 10% yields, and should have done back in 2008, 2009. Now, I do agree with what Louis said earlier that it's like used to be the U.S. economy drove the stock market. Now I think you can make a cogent argument it's the S&P that drives the economy. And if the S&P goes down severely, I don't believe they're just going to sit there and do nothing. I believe that they will intervene and actually buy equities. Yeah, but it's going to take a major market decline. That might happen very quickly in a crash. I think those are not probably as likely to be the catalyst as one where it's kind of this grinding decline like we saw from 2000 to 2003. But I think it's going to happen at some point. And as Louis knows, and I think most Americans don't, this actually has a successful precedent because during the Asian crisis in 1997-98, I think it was 98, the Hong Kong Monetary Authority intervened and the Hong Kong stock market was in free fall. It was down 60%. They bought a ton of stocks at the low they put in the market and they made a lot of money, just kind of like the US did actually with TARP. So yes, I think that's going to happen, mostly because I don't think the federal government, just like we were saying earlier, they can't allow the equity market to really fall out of bed and stay out of bed. It's one thing because, these flash crashers, that's a different story. Louis, I mean, you don't have to agree. Nobody agrees with me about that.
And I agree.
You do? Oh,
No, I gotta say, 2008, they took equity in AIG, they took equity in Citi. So
And they made a
yeah,
killing.
yeah, but
They made a
so there's a
killing.
precedent for it, right?
And the Hong Kong Monetary Authority made a killing too. And I mean, in a way, if you think about it, that it's like if you buy stocks at very depressed prices, so they have a very high earnings yield. It's almost like you're lending, to the bond market at a very high interest rate, just with a little different part of the capital structure.
Yeah.
So yes, I believe it's going to happen. But again, don't get me wrong, it's going to take a fairly significant equity market decline to trigger that.
Yeah.
Well, we're over an hour, but if we have people dying to ask Louis a question, we can run a little bit longer. Everybody wants to leave, they can leave, obviously.
Nothing in the comment section. So if anyone else has a question, you can just go ahead and unmute and ask. Or that was from Sean. Sean says thanks.
Thank you, Sean, for being on here.
Okay, this was recorded. We'll be sending this out to Haymaker subscribers and also to the Evergreen clients and to whatever extent that overlaps, obviously. So no other questions. Thanks to everyone for attending.
Thanks so
Press
much.
up, Louis.
Thank you. Will this be behind a paywall, or will this? Because if it's not, I'll forward it as well.
We usually paywall them, but
Okay. No
But
worries.
Evergreen won't. Evergreen's not going to paywall it. This is actually, going to be available for Evergreen. We don't have to
Okay.
paywall this.
no. Okay.
I think we can make that choice. I think I just want to make sure we give our tier one folks a few days head start.
Perfect. Thanks a bunch, guys.
Thanks, Louis. Great job.
Thanks, Dave.
Talk to
Thanks,
you
Louis.
soon.
Thanks a bunch.
Bye.